I said with gold, I think 10 years from now, measured in US dollars, gold is going to be a lot higher than it is right now, and I think Bitcoin is going to be higher than it is right now. The Federal Reserve itself is insolvent right now. I think they would link their currencies to a commodity. If you're a government, you like the ability to run the printing press to cover your bills. It's possible that the U.S. Treasury has to do a default, whether explicit or like a stealth default. I wouldn't say I'm bullish on bonds per se, and that's just because there's so many problems with the underlying system.
Hello, my name's Mark, and you're watching Resource Talks. Today, I'm joined by Robert Murphy, who is the chief economist at a financial services company and a senior fellow at the Ludwig von Mises Institute. Robert holds a Ph.D. in economics from New York University, and he's worked in academia, the financial sector, and been involved with several free market educational institutions. I'll be asking Robert about all the big economic topics like inflation, monetary metals, and where he thinks we are currently in the business cycle. Before we kick off, remember that despite Robert's impressive background, he's not in a position to provide you, a stranger watching him online, with personal financial advice. So please take everything you hear with a pinch of salt and do more research before taking any decision with your money. With that said, Bob, thank you for coming on the show.
Thanks for having me, Mark. You've had a lot of distinguished guests, so I'm honored to be on this platform.
It's very kind of you to say. I saw you were on Jordan Peterson's podcast not long ago, so I would say that coming on our show after that must feel like leaving a symphony and walking into a beginner's kazoo class.
But, a lot of people can do a lot with a kazoo, so...
Could you start by telling us about your background, starting with the PhD and how you ended up as Jordan Peterson's go-to economist?
Sure. So when I was like in junior high school, like 7th and 8th grade, I thought I wanted to be a physicist. Richard Feynman was my hero, and that's what I was going to do. And then in high school, I discovered economics and just started reading in the what we'd call free market tradition. In the U.S., what would be called libertarian, that wing, Milton Friedman, people like that, Thomas Sowell, Walter Williams. And then I got into what's called the Austrian School of Economics. I'm sure many of your listeners have heard of that. People like Ludwig von Mises, Hayek, and Murray Rothbard. And so by the time I graduated high school, I thought I was just going to go be a college professor for my career. And so I went to Hillsdale College undergrad, where they had Mises' personal library, and then New York University, where Mises had taught for many years, to get my PhD in what was a specifically Austrian fellowship program there at NYU. It was a regular coursework, but the dissertation was an Austrian flavor. And then I taught for a few years, and then just academia wasn't what I had thought it was going to be, and so I went over to New York City to try to get in the financial sector, because again, with my physics background, as I'm sure many of you listeners know, like what are called quants on Wall Street, like that, a lot of the math is the same as what they use in a certain branch of physics. And so I thought, I can get into that. It's kind of killing two birds with one. Anyway, Arthur Laffer hired me of Laffer Curve fame, and he was moving his firm to Nashville at the time. So that's what took me to Nashville and got me into the financial sector. And I started realizing you can take these abstract economic principles and then make some real world applications. And of course, it wasn't a one-to-one, there's a lot of uncertainty, but I saw a lot of the people talking to the public about the economy really weren't being very rigorous at all. And so I got over my misgivings to say, well, at least I can try to be more careful and give them better guidance than some of these folks are. And that's how it started. And, yeah, so I do a lot of work, as you mentioned, the intro with the Mises Institute, talking about general Austrian principles, talking about business cycles. That's kind of my area, money and banking. I'm sure we'll get into that stuff soon. And then, I also work, as you mentioned, chief economist at Infinio, where we use certain financial products to try to help people, businesses and homeowners and households just work on personal finance with these principles.
I live in Argentina, and so I was especially interested to see that Javier Milei, who's a bit like a Bolsonaro or Trump-like figure over here, mentioned a book that you wrote in a recent debate. So if he wins the elections later this year, how many briefcases of Argentinian pesos would it take to get you out here on his advisory panel?
Oh, it wouldn't take many because it'd probably be good PR for our company. So probably yeah. So that was a surprise to me too. Somebody just said, I don't know, did that debate just happen? Because somebody just sent it to me like a week ago too. That and I only speak English fluently, and so but I could hear the chaos theory mentioned. So that's what's interesting for your listeners too. It wasn't some mainstream thing about me talking about GDP growth. It was a very esoteric thing about using insurance companies to sort of replace some of the traditional functions of the state, like even military defense and law enforcement and things like that's what he was referencing. So that's pretty impressive for a presidential candidate to be getting into the weeds of something like that. So yeah, I was very pleasantly surprised when someone sent me that clip.
Yeah, well, he's not a conventional presidential candidate. In fact, I understand that one of his dogs is named Murray after Murray Rothbard. So he's got quite who's an Austrian School economist. So he's got quite a long history with being interested in that school of thought that you're representing.
Yeah. Also too, just I don't. Do you know what NPR is? National Public Radio in the United States.
Yeah,
So it's very, just as National Public Radio, like as the term suggests. And they did a story on him, like I don't know, a month ago. And the two correspond, like the person, like the host who was handing the story off to like the local person who did all the research, they were both saying, "What does this word anarcho-capitalist mean?" And the other person said, "Yes, I had to look that up." And so it was just funny that if nothing else, he provoked them to have to go look up the definition of anarcho-capitalist.
Yeah. So you could end up being like one of the Chicago boys, the free market economists who gave advice to Chile's Pinochet in the 1970s, only hopefully with fewer extrajudicial killings.
Yes, optimally zero. Yes, that's going to be my recommendation.
Yeah. So before we get into any nitty gritty questions, I'd like to get a very general sense of your outlook for the global economy. So if the world economy and financial system were an ice cream flavor, are we talking vanilla or rocky road?
Oh, rocky road with some, I don't know, hot sauce that was put in there in the middle that people didn't know about. They're going to find out soon. Yeah, it's I think there's going to be certainly in the United States, and then presumably that will follow through to Canada and major European powers as well. I think there's going to be a bad recession in 2024. And if you want to talk about what indicators are making me think that,
yeah, please.
Sure. So the main thing that has widespread appeal or cachet, it's not just a specifically Austrian metric, is the inverted yield curve. And I'm sure a lot of your listeners have heard of that, but let me just make sure they understand. So inverted yield curve, of course, meaning that the yields on short-term treasuries are higher than long-term, which is not the normal pattern. And so the specific measure that I look at is what is it? It's the 10-year minus the 3-month, that particular measure of the yield curve. If you define it properly and like use a sufficient duration, it's not just like an intraday, thing that happens for a few moments, but if there's sufficient duration, that particular measure has not had a false negative or a false positive, at least since the end of World War II. Or at best, sometimes people quibble, it's signaled a recession, and then it was just a slowdown in GDP that didn't quite get classified as a recession. There's things like borderline Cape, but it's not just been wrong. And both ways, that it's, again, no false negatives or false positives. And so that thing has been deeply inverted. The most it's been inverted since the late 70s, for a while now, like coming up on a year. And so again, if we don't have a recession in 2024, this would be a huge exception to what the pattern's been since World War II. And then there's a bunch of reasons that other economists, many of whom politically are in favor of the Biden administration, so I think they're partly biased, but the arguments they've been giving for a while, the Fed has pulled it off, there's going to be a soft landing. The critics said if they raised rates aggressively, there was going to be a crash, but no, we're fine. All of the metrics they've been pointing to were also true back in July of 2006. And if your listeners can go do this, go to Google News and just do a date restriction and type in soft landing for the year 2007, like for US news sources. And you'll see everybody was saying, well, not everybody, but lots of people were saying in late 2006 or early 2007, the US is in store for a soft landing, including like the Dallas Fed, not just some guy on CNBC who ran some bond fund, but like major people, and Ben Bernanke also. And of course, we weren't in store for a soft landing then. We were on the eve of the global financial crisis. Okay, so again, the things that typically signal a bad recession's coming are true, and the reasons I've seen that people are giving as to why, oh no, we're not going to have a bad recession, they were also true, in July of 2006. When the reason I'm picking that is because the Fed had been raising rates and then stopped in July 2006 at 5.25%, incidentally, saying, okay, we think we got, because the housing bubble was going and inflation was rising, saying, okay, we think we got that under control now, and unemployment was not high, and it still went down for several months after they stopped hiking. So the situation it wasn't as low as it is now, but it was low. And so that's why everyone at the time thought, okay, the Fed pulled it off, soft landing, and obviously no. So, and all that ties into the Austrian theory too. I don't know if you want me to talk about that as to what is it that causes the business cycle. In other words, I'm not just looking at curves and doing, empirical correlations. Like there's a theory behind what I'm saying.
Let's save the conversation for the Austrian business cycle theory for a little bit later, and talk about inflation in this moment. So obviously, we all remember that inflation was initially labeled as being transitory and blamed on COVID-induced supply side issues, not excessive money printing. Yet you argue that the Fed and its money printing is to blame for the recent bout of high CPI readings. But how then do you explain the minimal impact on CPI after the monetary base was doubled in a short amount of time following the 2008 great financial crisis? Why was it different this time around?
Yeah, then great question. And that's something, I don't know if you're asking it because you saw I had given a talk on that, Mark, but yeah, I specifically, and I'll reproduce, distill down my main points here for your audience. But yes, for people who are interested, it was at Mises University in the year, I think 2022, that I specifically tried to cover that, because you're right. I wanted to be intellectually honest that a lot of people like in my camp now were running victory laps, making fun of Paul Krugman and people like that, saying, aha, they thought the Fed could just create a bunch of money and dump it in the system and prices weren't going to go up. This is Econ 101. And so you're right. And to be fair and intellectually honest, I was saying, okay, but a lot of us, including me personally, thought we were warning people back in 2009 that quantitative easing was going to make CPI start rising aggressively. Because it was also, too, there were supply side restrictions then. The incoming Obama administration, they were talking about doing a cap and trade or carbon tax, things like that. They were obviously what they were going to do with healthcare. So there were a lot of things that I would have thought would have slowed real output growth, coupled with the Fed at the time doing unprecedented money dumps in the system. So I thought surely CPI, and that didn't happen, as you say, or didn't happen as aggressively as people worried about. So one big difference is, and this is only something I realized after the fact, the thing that in 2008, 2009, the reason I thought you were going to see an impact is because there's like just because the Federal Reserve puts in a bunch of new base money, like creates new reserves in the system, that doesn't one for one necessarily translate into more money in the hands of the public. But even measures like what's called M1, which is like actual physical currency and green pieces of paper, and the public's checking account balances with the Fed, that went up significantly in 2008, 2009. And so I was looking at measures like that to say this money, because people were saying, oh, the money's bottled up in the banks. And I was saying some of it is, sure, but a lot of it isn't. Like a lot of this is really passing through to checking accounts. So the public has a lot more money in 2010 than they did in 2007. And yet we don't see gasoline being $6 a gallon. So why isn't that? And what I noticed, though, is if you looked at M2, that didn't rise very significantly in 2008, 2009, whereas it did rise in 2020. And so in terms of trying to look at the different aggregates, and I'll explain in a minute, like what's the distinction, but that's so, yes, in both periods, the Fed did a lot, but during the wake of the financial crisis, M2 didn't rise. Like if you just looked at a chart of M2, you wouldn't have realized something crazy happened in 2008. Whereas if you looked at M1, you'd say, whoa, what happened then? Whereas with COVID, 2020, 2021, both M1 and M2 just skyrocket. Okay, so that's how you could tell. And so specifically, part of what's going on is M2 has things like money market mutual fund balances. And so during the global financial crisis in 2008, things like big institutions, like they broke the buck. And so a lot of investors panicked and they were moving out of things that used to be considered safe or like almost near cash and putting them into literal checking accounts, because that, FDIC in the US had expanded its, I think it was 100,000 per account. And then they expanded to 250,000 right when all that stuff was happening. So I think a lot of what you saw with the checking account balances mushrooming in 2009 was just the public rearranging the distribution of their asset portfolios in things that M1 was catching. But, so that's why M2 didn't rise significantly. It was just a rearrangement of things, some of which were M1 and some weren't. Whereas in the COVID regime, everything really was just mushrooming. So I think that's part of it, that the financial crisis, people are worried and they hoard money. So that's maybe one way to answer your question too, is the demand to hold money went way up also in 2009, 2010, and that kind of just absorbed all the new supply. Whereas in the COVID regime, people were uncertain about the future, but they were happy to spend, right? It wasn't that they were hoarding cash because they were uncertain. It was more like, when do I get to go back to work kind of thing. And they were getting all of the stimulus checks in the United States I can speak to. And so people weren't as worried about, I think there's kind of thing like, as soon as the government lets us go back to work, we're going to have a job. Whereas, in 2009, people were worried if they lost their job, am I going to get hired again? Because people are telling us the banking system is going to collapse. So I think that's part of the distinction. And that's why the money that got dumped into the system in 2020 showed up pretty soon in terms of higher consumer prices.
So does that mean then that had the Fed not massively expanded the monetary base after 2008, we would have seen huge contractions in M1 and M2?
Well, I don't know about contractions, but certainly they would not have gone up. You would have seen falls in the consumer price index. You actually did see that in, I think it was November of 2008, in terms of the monthly data. The CPI actually did come down somewhat. So yeah, I think for sure what I'm confident in saying is, in a sense, what the Fed did with the rounds of QE did raise consumer prices relative to the counterfactual. It's just that had the Fed done little, then prices would have consumer prices would have come down. And so by the Fed boosting them, the measured, result was just that they still kept rising, moderately over that period. Because
that was, of course, the Fed's objective, no? Because they wanted to avoid a deflationary cycle that, in their view, could have caused a long, drawn-out recession, wherein people deferred spending and deferred investment because they could see that prices would keep falling further in the future. That was the theory behind it, no?
Oh, right. So yeah, just on those narrow terms, and that even did happen when I was explaining some of that stuff. People who were defending the Fed's actions, or at least saying it was better than nothing, they may have quibbles about the implementation. Right. They said just what you said, that, okay, so even on your own terms, then it's a good thing, right? So yes, in terms of what the Fed was thinking, or at least what they were publicly stating, avoiding falling consumer prices was an objective. I personally think falling prices are fine. Like that's one way, struggling households, the silver lining in a recession used to be, back on like the gold standard days, that, at least if there was a boom and prices rose, then prices would come down, and that kind of maintained the purchasing power of the dollar over the long run. So that this period, this regime that we're in now, where your dollar's always losing value, it's just sometimes it loses it more quickly than others. To me, that's not a good thing. For example, like nobody says, the computer industry can't function because the price, per kilobyte or megabyte of RAM or something keeps coming down. So every time people get ready to buy a new computer, they just wait a year, because what they're going to get for their $1,000 keeps getting better. So that's why the computer industry has no innovation. No one talks like that. Like, you can build in expectations about prices coming down, and it doesn't just halt spending. So I think some of those fears about a deflationary spiral are overblown. But yes, on face value, if that's what the Fed did, you could argue that's what they were trying to do.
And bringing the conversation back to the present day and the future, US CPI shot up by 3.7% year over year in August, which is higher than what we saw in July and also above what everyone was expecting. And yet still the market's only giving a 40% chance of a rate hike in November. So do you think that's a bit low, especially considering how energy prices are being pushed up by global issues?
Yeah, so here too, I want to be nuanced. So it's typical. A lot of people like in this space who are talking to the public about financial matters, right? They're perma bears, or they're always worried about hyperinflation just around the corner, that sort of thing. And by the way, I wasn't even in 2009 and 10. I wasn't telling people I thought there was going to be hyperinflation. I was just saying I think price inflation is going to be rising, at historically high levels for the U.S. But back to your question. The Fed really has been tightening. So a lot of times when it comes to government agencies or quasi-private, quasi-government agencies in the case of the central bank, they talk a lot, and the media narrative makes it look like one thing's happening, but really isn't. But in this case, I mean, if you're looking at interest rates, they really did raise interest rates pretty aggressively, compared to historic norms. The monetary base was falling, and then even measures like M2. If you look at a chart of M2, it peaked and has been coming down pretty aggressively, which is unprecedented, at least going back several decades. Like as far back as certain data sets I've seen for M2 itself, to not just slow the rate of growth, but to have it come down. So I think if the Fed doesn't switch course and just start pumping more money in aggressively, I do think they have gotten, they turned the corner. I think consumer price inflation is still going to be a lot higher than what they say their official target is. So I'm not saying the Fed has done, mission accomplished, but I don't think you're going to see inflation start creeping back up to, what we saw before, when everyone was erroneously saying, oh, this is just transitory. This is just supply bottlenecks. Don't worry, this will go away. So they were wrong then, but that's because at the time they had pumped in all that new money and that was still working its way through the system, I think. Whereas now the Fed really has slowed the creation of, actually the stock of money has been falling. And so to me, that's so you're right. There's been a blip upwards in energy prices and things like that. But I don't think that CPI is going to rise to 7% absent, some kind of huge shock.
Right. So am I understanding that you think it would be right for the Fed to take a pause here and see what happens next rather than to continue hiking aggressively?
Well, if you're asking me what is my prediction, right? I don't think the Fed's going to keep. I mean, they might have one or two more, quarter point hikes or something, but I think, that they're close to the end of the cycle in their way. Because again, I think the economy's poised into going into a recession. So I think as each passing month and the new data come in, the Fed's going to get more and more pessimistic about the future and then start pivoting to, at some point, we're going to need to start cutting rates. So that's, so maybe they have one more. My guess would be they have maybe one more rate hike. That's, I think the announcement's coming as you and I are literally recording this, so we'll see. So maybe they'll have one more rate hike, but I think that's probably when it would peak. And then eventually the question would just be, when are they going to start cutting? Because in my view, the economy's in worse shape than the Fed is officially saying. Maybe behind the scenes, they're looking at the same stuff I am and have the same view. But beyond that, though, what I would say, though, Mark, is I disagree with the whole framework of having it. In other words, like it would be like in the Soviet Union, if the Planning Bureau is setting the price of crude oil, and then they ask me, "Oh, what do you think it should be next month?" I don't know. There shouldn't be a committee that's setting oil prices. Likewise, here there shouldn't be a committee setting interest rates. So to me, the best thing, would be to just return money in banking to the private sector. So it's kind of hard for me to answer your question.
Yeah, I mean, I can see you're itching to talk about the Austrian business cycle theory, so I'll set you up. The financial press often likens interest rates to a car's gas pedal, right, where lower rates speed up the economy until it overheats and causes inflation, at which point the Fed needs to raise rates to get things ticking over smoothly once again. But I understand that you have some issues with that conception of the economy. Could you walk us through what's wrong with that metaphor in your view?
So all of this is coming from the theory of the business cycle or the boom bust cycle that was primarily developed by Ludwig von Mises, and then his sort of follower. He wasn't literally like his student, but a person who came into economics, Friedrich Hayek, and so people often call it the Mises-Hayek business cycle theory. And this is what Hayek won partly what he won the Nobel Prize for in the 70s. So their view is that interest rates are market prices. Like they communicate information. So just, go back to my oil analogy. If the price of crude oil hits $100 US dollars a barrel, then, that's painful in a sense to oil consumers around the world, but that's genuine information. They need to know that if the price of oil is supposed to be $100 a barrel, then that forces people to economize. They try to, try to find other uses. People don't drive as much. Airlines might cancel some flights because jet fuel is so expensive. And so that's just the way the market responds. And so if the market interest rate is supposed to be 5%, depending on specific maturity and risk of what we're talking about, the asset, that means something. That refers to actual conditions of the underlying economy, like how much households are saving, investment opportunities, however you want to frame it. And so if the central bank comes in and creates a bunch of money electronically out of thin air and advances it in the loan market, and that pushes down interest rates, that's not helping the economy. That's not making us wealthier. Just like if somehow the government, if the price of oil was $100 and they put a cap at 70, everybody knows, like that's what happened in the 1970s in the US, that there were long lines for the gasoline pumps because there were price controls. That didn't create more gasoline. In fact, it created less. So when it comes now to interest rates, though, it's when the Fed pushes down interest rates, it's not literally a price ceiling. Like they don't just say, if we catch anybody charging a higher interest rate, you're going to get fined. Otherwise, it would just cause, shortages. But instead, what they do is, again, they flood the market with fake money. And so, well, not fake money, but money that's not backed up by genuine saving. And so in the Austrian view, if the interest rates fell because households were genuinely saving more and there was more, capital being set aside to deploy for longer projects, that would be a good thing. That would be healthy. The lower interest rate would communicate the right information. Entrepreneurs could borrow on better terms. Present value calculations of projects at the lower discount rate would show that, a project that's going to take an extra 5 years, but, has this big payout, now it's profitable. So in the Austrian view, it's the interest rate helps coordinate over time, the length of projects. Like how long can we have equipment and machinery and resources tied up before the payout hits down the road? And the interest rate helps regulate that. And so if the interest rate is artificially low, that causes an unsustainable boom. It looks like we have more savings than we really do, and entrepreneurs start long projects, but then, there aren't actually more factories. There's not more farmland. There's not more people with, who've been trained as brain surgeons just because the central bank creates new credit and puts it into the loan market. So that's the idea. So there's going to be a crisis typically when price inflation starts rising. The Fed and the central bank and the conventional commercial banks, they get skittish. They let rates rise, and then that's what causes the crash. But in the Austrian view, it's not a policy. It's not that, if the Fed just kept rates low forever, we'd never have a recession. It's like, no, ultimately the currency would collapse. Like you're just postponing the day of reckoning if you do that. So yes, having rates rise, kind of circling back to your earlier policy question, in the Austrian view, if the Fed stops pumping in new money, the equilibrium in market rates of interest rise, and it might cause a crash. But the crash was inevitable. Like the seeds of the crash were sown during the boom period when people were being misled by artificially low rates. And so it's better to have the crash and get it over with. And then if you just don't inflate anymore and let interest rates be their market clearing levels, then you'll be on a solid footing from that point forward.
Can I put an objection to you then about the Austrian business cycle theory? Based on my rudimentary understanding of it, suppressed interest rates are supposed to encourage lots of long-term capital-intensive investments that ultimately can't be sustained. But as a commodity focused podcast, we often hear industry experts complain that there's been massive underinvestment in building new mines and smelters in recent decades. And what we've seen instead is, a bubble in the price of JPEGs of Bored Apes, or, big run-ups in the valuations of tech companies or Dogecoin. So how do we square that with Austrian business cycle theory?
Okay, so well, certainly the elements of speculation in seemingly frivolous assets, like you say, certain NFTs and whatnot, that is consistent with the Austrian story. That, like, oh yeah, credit. I mean, you see it. I've seen memes too, like where it's like a silly one is showing like the Calvin Klein models in, what was it, in 2022 were not typical looking, and then in 2023, like they look more like the traditional ones. They said, see, once we got rid of, once interest rates came back, or they're making a joke, like just trying to show weird things happen, unusual things happen when interest rates are artificially low, and then once they start rising, everything goes back to how it used to be. And so so that sort of thing, that if interest rates are really low, if companies can, and this is partly like with the Silicon Valley Bank and such, the saying, like a lot of their customers who are tech clients, when interest rates are almost zero, companies could come in with plans that, we're going to do things that aren't going to hit for 10 years. We aren't going to show any profits for 10 years, but down the road, we might have, zero gravity cars or something, that people are willing to advance money and long-term kind of crazy ideas if the carrying cost of that is almost negligible, right? So whereas if interest rates are 5-6%, then all of a sudden that kills a lot of those things. So that element. Now, as far as like to say, okay, but then still investing in mines and such, what I do know is that I'm more familiar with the oil sector, and in the U.S. there were a lot of mine, like talk about fracking and things like that I know when interest rates were low, there were a lot of people saying how, these projects are only profitable if oil prices are in this certain range. And they thought that was driven by cheap money. And they were warning that, as rates start to rise, a lot of these wells are going to, all of a sudden be uneconomical. So, again, I can't comment on the specific, but I can just say, though, other things equal, if you have a project that involves some upfront investment for a few years before, you start to anticipate that the supply that's coming from it that you can then sell, other things equal, lower prices would tend to make it easier to finance. And also more inflationary policies, I think, would raise expectations about the future spot prices of those commodities. So you would think both of those would militate in favor of, making investing in a particular project more profitable. But again, if the claim is these other more frivolous things are taking away investment dollars, I guess I could understand that. But other things equal still, the profitability of a given project at a lower interest rate should make it higher.
Many of our listeners are particularly interested in mining stocks and physical metal funds, everything from uranium to copper, oil, lithium, nickel, and precious metals as well. Do you think Austrian business cycle theory has any practical applications when it comes to understanding the ups and downs for commodities?
So I think it's a necessary but insufficient bit of information to be a successful investor, right? So you, as an investor, and Austrian economists, I think, are actually better than other mainstream economists in terms of acknowledging, the limited usefulness of what they're doing. That a lot of what the Austrians talk about is, after all, like a critique of central planning. Like that's one of Mises's famous contributions, was to explain why central planning, even in principle, even if everybody meant well and had a lot of information, couldn't work, that you need the market system to guide everybody. So Austrians certainly defer to the on the ground expertise of the actual investors that have skin in the game and so forth. But what I would say, though, is to the extent that, you can make all of the best assessments and look at the labor cost and know about I can make my extraction efficiency 0.2% more than this rival over here, and that's why this mine's going to operate. But if there's a huge global recession, that can kind of swamp your individual micro assessments. And so that's why I would say learning at least the basics of Austrian theory like Google my name, Robert Murphy, inverted yield curve, just to see, what we're talking about, just to get a sense of, that surely is going to help you in your decisions, to just have a sense of, oh, wow, yeah, if there's a bet. For other things, like obviously the demand for certain commodities is going to go down if there's a global recession, and Chinese demand for Chinese exports drops and so forth. Like that's clearly going to have an impact on at least the short to medium term and prospects for a mine, things like that.
Hmm. Recently, I had a chat with Michael Howell, who runs Cross Border Capital over in London. And he made an interesting point about interest rates that caught my attention. I'd like to get your reaction to it. He argued that Western economies might not react to interest rates as much as we've been led to believe by traditional economic theories. And he brought up that low interest rates didn't really boost growth post financial crisis or even after the COVID pandemic. And so he asks, why would high interest rates necessarily put the brakes on the economy now? And he thinks that the reason is that because we've got aging populations that aren't really buying big ticket items like houses and cars anymore, they're not taking out as many loans, and so they're not as interest rate sensitive from that perspective. And he also mentioned that businesses these days, especially in the services sector, don't need as much capital to operate as manufacturing companies do. And plus, when there is a need for big investments, it's often driven by government incentives for eco-friendly projects, making them again less sensitive to interest rate changes. So what's your take on this? Do you think that interest rates have lost some of the clout that they had compared to what economic models from the last century would suggest, now that we're in this sort of post-manufacturing world in the Western economy?
Well, let me first address, the first part of his argument. I think what you said is that he was saying, oh, the rock bottom interest rates, like after the financial crisis and then after the COVID hit, didn't correspond to robust economic growth. And so, if it didn't work, if for instance stepping on the gas didn't work, then who's to say pumping on the brake is gonna also slow the car down, right? If I understand that. So as far as the first thing, this is obviously a quick take, but I think it's more that because there were so many other problems on the supply side after the financial crisis, that again, the reason you didn't see real GDP growth skyrocketing is because just the fundamentals of the economies were all in disheveled. They were screwed up from the housing bubble years. And so even in Austrian theory, it's not that we think that it's put it this way, that yes, there was a boom relative to the counterfactual. It's just that had the central banks done nothing after 2008, there would have been a pretty serious correction. And so I would put it that way. So yes, it did prop up the system, but the reason it didn't feel like, oh, we have a lot of prosperity, is just because the counterfactual would have been so bad. And again, in the Austrian view, that would have been a necessary readjustment. It would have been reality, but it would have been painful for a year, had they let that happen. So I think that's to express that. I mean, certainly, yes, certain demographic trends, other things could affect the sensitivity of interest rates. I think another huge change, like what's happening in the current system, is just the amount of debt that not just households and businesses, but governments in particular have amassed over the last 20 years. When interest rates were very low, it wasn't so painful to run up the debt. But now that interest rates are returning, just not even high levels, but just kind of more coming back to historical norms, just the financing cost of the existing stock of debt, I think, is really going to pinch a lot of governments. And so that's an element too that I think is going to be different from previous cycles. So yes, I agree. There's lots of differences in the particulars, but I do, like I say, it's the yield curve is inverted, just like it has been in previous cycles, and I think there's going to be a bad recession. So maybe he's right, but I would want to get through 2024. And if there's not a bad recession in 2024, if things just continue like this, then I will have to look for reasons why this time was different. But so far, to me, I think it's still going to be a bad recession.
So if you're predicting a bad recession, does that mean that you think that inflation is going to fall with falling aggregate demand as well?
Certainly in the U.S. Right. So I can't speak to other countries and what their central banks would have done, but right. And like I said earlier in this talk, in the United States, just about any measure you can look at, that the Fed really has been tightening. Not just slowing the rate of increase, but actually that certain measures of the money stock have been coming down. And so, yes, if you couple that with a bad economy, so everyone's demand to hold cash increases, right, I would think it would come down. Now, obviously, once things start tipping, the Fed's going to probably switch and go to an expansionary policy. And so then, it's hard to say which force is going to, predominate. Obviously, like in the 1970s, you had high unemployment and high price inflation. So I'm not saying that's impossible. I'm just saying, though, that the Fed would need to start pumping in money. But so initially, I think you're going to see falling CPI before you possibly see a flip.
So does that mean that now is not the time to be allocating towards inflation hedges like gold?
I suppose I would say if somebody has been doing that for 10 years, now would not be the time to add to your hedge. But for somebody who's for a long time and saying, yeah, once I get, like an individual investor who says, oh, yeah, I've been in equities this whole time, and now I'm starting to get worried, maybe I should reallocate. If you don't have any hedges against price inflation, you should get some, I would say. But right, I don't think that the threat from price inflation, at least in terms of the US dollar over the next 6 months, is bigger than it was over the past 12 months, put it that way. But yeah, I do think the long-term health of the US dollar is in serious trouble. It's just, I don't think in the next year you're going to see that. I think the predominant thing is going to be a collapse in real output.
Of course, if you'd invested in precious metals as a hedge against inflation back in 2008, you'd have massively underperformed broad market indices. So, over the following decades. So does gold really make sense as a long-term investment in your view?
Well, again, it depends if you use the term investment in terms of like it's expected expected appreciation. Perhaps yes, perhaps no. But if you're using it, as part of a hedge with a broader, portfolio that's serving that function, then I do think gold and maybe some other things too, depending on what your portfolio is, makes sense to hold. But knowing, it's sort of like saying, is fire insurance a good investment? Like it's either it is or it isn't. But that's not really the right way to think about it. So like that's kind of what I would do with saying, having some gold in your portfolio. That certainly, I definitely think 10 years from, let me put it this way, just to give your listeners some more specifics that again they can use, or I can be wrong. I think people are underestimating the degree to which the US dollar is going to lose its reputation over the next 10 years, let's say. That I think people kind of assume things are going to continue the way they've been. And I think that the US in general is going to be a smaller player on the global scene 10 years from now than a lot of people are projecting. I'll put it that way. And so I think the US dollar is the demand globally to hold dollar, like treasuries and things, I think is going to be shrink more quickly than most other analysts think.
And do you have a view about which currencies might appreciate relative to the dollar over those 10 years?
I don't know so much that it's going to be that any particular currency is going to displace the dollar per se. I think you're going to see more, if they were smart, like the Chinese or the Russians or some group of the BRICS nations, some subset of them. I think they would link their currencies to a commodity or to a basket of commodities. And there's been talk about this, and then they never quite do it. So that's really, if they were serious, if they want to, if they had a bunch of ministers get together and say, our plan is, even though it might, cost us something in terms of our treasury, but let's really get investors around the world to start using our currency when they price transactions, or, in terms of, the fixed income tied to our currency is what they start using in their allocations for safety, to make it redeemable in gold, or again, a broader basket of commodities if that seems more practical, and then stick to it. So the first time there was a crisis, if they really stuck to it and they didn't devalue, then people would start to trust it, and that I think would quickly accelerate. The reason though they don't, because again, you've seen Chinese officials, Russian officials over the years, and then now the BRICS are talking about that. I think the reason they haven't really pulled the trigger is if you're a government, you like the ability to run the printing press to cover your bills, right? So it ties your hands to say we pledge to always redeem our currency with this amount of whatever, gold or whatever, some basket of commodities. So that's partly why they don't want to do it. But to answer your question, I think if a major player did do something like that, then you would see that thing displace the dollar. But in general, I don't think it's going so much towards, there's going to be another superpower, which at this point would have to be China. I think it's going towards a multipolar system, as opposed to the US is kind of like the big boy in the room.
And what would be the logic of tying a BRICS currency to a basket of commodities? Because commodity prices are very volatile, aren't they? Why would you want to trade in a currency that tracks the price of wheat, for example, that can go up and down based on weather conditions or, thousands of other factors? Wouldn't it be better to have, if you're, against central banks inflating currencies, something like what Milton Friedman suggested of, a central bank that's just run by an algorithm that increases the monetary supply in a very neutral way?
Well, but what would be the algorithm? I mean, you could have an algorithm doing it, so it sort of takes human discretion out of it. But the question is just, what's the algorithm doing? So under the classical gold standard, all the currencies of the major powers were tied to just one commodity, gold. And, and that's so but I'm not necessarily endorsing this, but I'm just saying the rationale to say why couldn't it be a basket of commodities is actually to say that's less volatile. Because, the fortunes of gold mining could fluctuate, or the demand to hold it or whatever. And, so the whole global economy could be dependent on this one metal. That seems kind of crazy. So the idea is, okay, well, in the basket, you'd have gold, you'd have platinum, you'd have wheat. So you'd have a basket. So the idea is that the volatility would be spread out on, would be tamped down, and not just have one particular thing in the basket. So that's the rationale for it. But again, you could do an algorithm. It's just, what is the algorithm doing? So that's the idea. There would be no discretion if it were a hard commodity standard. The idea is just, no, their job is they adjust, their open market purchases or whatever, just to make sure that the price of that basket, stays within that narrow band. And also, it's not just a targeting rule. It's really to make it plausible. They literally can redeem for, that you turn in the thing that they give you futures contracts entitling you to delivery of the actual physical commodities. To make it, and so what the central bank would be doing is managing its portfolio of all those futures contracts or something.
Talking of gold and inflation hedges, Bitcoin was sold as digital gold for years, especially by people in libertarian circles. But after last year, when inflation really took off and we needed an inflation hedge, Bitcoin absolutely tanked, showing itself to be more correlated with profitless Cathie Wood stocks than gold. So do you think after last year's rout in the cryptocurrency markets, there's still a case for holding Bitcoin in your portfolio as an inflation hedge?
I think there is a case, and I certainly hold some Bitcoin, and as I grow my portfolio, I'm going to have more dedicated to it, again, just as a hedge. Like I said with gold, I think 10 years from now, measured in US dollars, gold is going to be a lot higher than it is right now, and I think Bitcoin is going to be higher than it is right now. Now, does that mean that's the best thing to do? No, I'm not saying put 50-50 in your portfolio in both of those, but I'm just saying that I think that having those is a good hedge, that they will do what they're supposed to over a longer term. You're right. So it was talking to some people who are more experts in the space. I think a lot of them, they kind of acknowledge, for one thing, yep, you're right. Bitcoin didn't do what it was supposed to if what you were doing was holding as protection against CPI inflation. But I think they would say there were a lot of sort of one-off factors to kind of, in other words, last year was kind of crazy. There were some things that happened that made people get out of crypto that, were sort of unusual. And that's not to excuse what happened or to say it's not crypto's fault that, those scams and whatnot were there. But the idea is that's, not so much the response to rising CPI. But you're right. Like I noticed that going into 2020, in March of that a lot of the, prices of Bitcoin and such were falling rapidly. And so I raised that at the time. I said, hey, I thought, this was supposed to be an emergency money, like when the whole system's collapsing, shouldn't everybody be rushing here? And yet, isn't it the other way around? And I saw the defender saying, oh, no, it's showing that Bitcoin's real liquid. And so in a crisis, you can sell it for money. And to me, I thought that was trying to have it both ways. That, no, it's not that when there's a crisis, whether it skyrockets or plummets, either way, it proves how good it is. That can't be fair. So I agree with you that Bitcoin has not done, and just even in general, right? Like originally it was supposed to be the market's money or, the voluntarist, analog or outlet for people who want to conduct commercial transactions. And then, as like as the price kept rising, people just wanted to hold, hodlers. And so then it kind of flipped to, oh no, just sit on this. And then, in the year 2100, when we had the Jetsons world, then the day-to-day money will be Bitcoins, but not right now. And it's not that that's wrong, but I am saying, I do point out occasionally to my, colleagues who are really into Bitcoin that the narrative behind this has changed several times. Like also too, in the beginning, it was, oh, this is all anonymous and you can't track you. And then it flipped to, oh, because it's a public ledger, law enforcement can find, you don't have to worry about drug deal. You know what I mean? It was like, okay. So they weren't necessarily the same people making those different arguments, but I just, the narrative behind it does keep changing periodically. So I acknowledge that.
So what is the actual use case of Bitcoin? I mean, it seems to me that you're not in the camp of people that see it as just a purely speculative bubble, like the obsession over Beanie Babies in the noughties. Clearly, you see some sort of utility for it. Otherwise, it should just have a price of zero. No? So, what is the use case for Bitcoin? Why should anyone want it?
So, good question. So, you're right. I know, like I'm friends with Peter Schiff and people like that who have since Bitcoin's come out been saying, oh, this is literally just a bubble. Once people regain their sanity, the only sensible, rational price for Bitcoin is zero. I understand their argument. And so my point, though, is even in conventional monetary theory, even with some like gold coins, the market demand for them as media of exchange, that's all in a sense speculative, right? Everybody agrees, even, gold bugs, that when the world switched to using gold as money, the demand to hold gold was higher than when it was just a mere commodity, right? And so if you use the, Schiff's idea, somebody could have said in 1850, like, oh, 90% of the price of gold is just pure myth. It's just held up by, irrational bubble expectations. It's just the big, the greater fool theory. The reason you're selling all that stuff in exchange for gold is because you think you can get the next sucker to take, right? And that the only floor is, it wouldn't be zero, but it would be whatever the commodity industrial use for gold is, or the jewelry or something. So you could make arguments like that. And then gold was in a 90% bubble for 500 years, right? And so that seems, so with Bitcoin, like I say, it's once it's up and running and it's been going in for several years, like I think that mere statement of what they think is like a fundamental valuation eventually loses its cachet. So the ultimate use case, so again, is what, reading the Satoshi white paper, what is it supposed to do? It is a way that they came with a very clever mechanism by which you can transfer control of these things. The public ledger can be such that to acknowledge that, oh, now this address controls, these particular units, and to be able to transfer that in a trustless way that's publicly verifiable and such. And that is an ideal framework for something that if people started using it as a medium of exchange would have a lot of nice attributes. That just to give one example of what I mean, ultimately, as human technology develops, you might get to a situation where it's like in Star Trek: The Next Generation when they have the replicators, like, oh, make me a Earl Grey tea, and it just, and that, if we had technology that could do that, well, then nothing physical can be the money anymore, because you could just say, make me a gold bar, and it could, just rearrange atoms from something real cheap into gold or whatever it is. And so it, certainly at some point, it's going to be necessary to have a purely intangible money. And so I think something like might not be Bitcoin, maybe it'd be something else that has, higher capacity, things like that. But I do think that you're ultimately going to see money that is just electronic, because again, the physical analogs will be too easy for humans to mass produce. So the scarcity wouldn't be there. So that's what I think. So given just that Bitcoin was the first player, I think in the year 2100, people will still know who owns most of the Bitcoins. Like that's not just going to be something people are going to not care about anymore. I think Bitcoin will still have value. It probably won't be the day-to-day currency. It'll probably just be like the equivalent of gold bars, sitting in a vault somewhere, but that will still be valuable.
So given that you're forecasting a recession, does that mean that you're bullish on bonds? Because presumably the Fed will lower interest rates if we actually do go headlong into an economic crash.
I wouldn't say, so you're certainly right that to me, like if I had to choose between fixed income versus equities, yes, fixed income is better given my overall view. But I wouldn't say I'm bullish on bonds per se, and that's just because there's so many problems with the underlying system that I think are there. Right? In other words, I think with this artificially low interest rate regime, there have been a lot of festering fundamental structural problems in the economy. So I think there's going to be a lot of defaults. So in particular, to like of major governments, that yes, other things equal, there's panic. Everyone's going to rush to U.S. Treasuries, but it's possible that the U.S. Treasury has to do a default, whether explicit or like a stealth default sort of thing. No, what we do at Infinio is we use life insurance and derivatives structured on that to plan. So I think there's ways you can rely on fixed income that's much safer than just going out and getting into a bond fund.
And are there any sectors, speaking of equities, that you are bullish on?
So again, with all these things, as you mentioned, your disclaimer, I'm not giving explicit financial advice, but what I do think is that artificial intelligence in areas, things where AI can really bring efficiencies, I think you're going to see that. Like right now, it's just sort of a novelty, and people are playing with Chat GPT and whatever the latest iteration is. But I really do think we've seen it in our own firm, where our chief technology officer, certain tasks in terms of programming, that now he's just learned to be conversant and just to have the Chat GPT generate the code. He's got to still go through and spot check it, but he's saying like, oh, once I could go, this will be making like multiply my productivity by like 3 or 4 times. And so I think that you're not going to be able to necessarily crank out more hamburgers per hour because you're using AI, but I think there's lots of businesses where they have to huddle and think through how can we use the AI to do it. But I think over the next couple of years, you're going to see that. So certain and a lot of it would be like financial industry firms in particular is where I'm seeing a lot of applications, but I'm sure there's other ones too. Again, things that are largely intangible that rely on a lot of the use of computers already with human oversight. I think you're going to see AI automate a lot of stuff in that sector so that their output just skyrockets. And so those sectors I think would do well even if the broader economy is in a bad recession.
So big tech like Alphabet or Nvidia.
I mean, yeah, if you're speaking specific things, sure, but yeah, more broadly, I would just say anything where that involves electronic output that's in digital form.
All of the listeners are going to be very disappointed that you didn't say uranium or copper or anything like that.
Well, I mean, but even there, I don't know enough about, but like in terms of using satellites and aerial footage to identify the ideal spot for the next mine. I mean, you're going to get AI involved in all those areas too. So I definitely think, but again, I think AI is going to help all over the place. And then the question is just which sectors are going to benefit disproportionately. So yeah, I do think you're going to see that spill over to all those areas. It's just where some of these industries, I don't know enough about their day-to-day operations to say specifically what's the innovation going to be.
No, of course. Bob, it's been fascinating to get the benefit of your knowledge and experience. Before we wrap up the conversation, though, is there anything that I didn't ask you about that you'd like to mention?
Sure. I mean, I guess I would just mention that the financial sector. So I guess this probably spills over into your question about the hedges and whatnot. Is that at least in the United States, which I'm more familiar with, the commercial banks, because they loaded up on treasuries and now interest rates are rising. I think there's more chickens coming home to roost. It wasn't just the quick wave of problems we saw earlier this year with SVP and Signature and such. There are hundreds of billions of dollars of unrealized losses still held by the commercial banks. So I think you're going to see that impact as well. In fact, the Federal Reserve itself is insolvent right now. Like that, it's sort of like an interesting curiosity. Not that day to day is going to have an immediate impact, but just to kind of show how weird things are right now with those rapid interest rate hikes. Technically, if you did mark to market, the Fed's liabilities are much higher in value than its assets right now. So that's technically insolvent, but no one cares.
And you've also written a number of books for a general audience, right? I read your politically incorrect guide to the Great Depression and the New Deal many years ago when I was at university, and I can recommend that to listeners. Is there anything, though, more up to date that you could give us the elevator pitch for?
Sure. So my book choice, put out by the Independent Institute, is what they asked me to do. Is they say, Ludwig von Mises has this tome that's 900 plus pages called Human Action. And besides being big, it's his language is, he wrote it in English, but it's very Germanic in terms of the sentence structure. And so they said, this is the Bible of Austrian economics, modern Austrian economics, but it's inaccessible. Can you write a 300-page book in plain English that a college undergrad, could read? And so that's what I did my book choice. So for people who were interested in what we've been talking, particularly like the business cycle theory, that's all spelled out. You don't need any prior knowledge. You can just take that one book choice, and that will explain everything from 0 to 1, as they say.
That sounds like a prompt for Chat GPT nowadays, doesn't it? Can you make this 900-page book readable? Yeah. Finally, then, where can listeners go to keep up to date with you? I know you're popular on that website, formerly known as Twitter, and you have your own podcast. Give us all the plugs.
Yeah, sure thing. So at Twitter, or formerly Twitter, I'm at Bob Murphy Econ. And then, if you just find me there, I tweet out everything or I X out everything that people will, want to find me at. But also, if you just go to bobmurphyshow.com, that's my personal podcast, and you're going to see links to everything else that I'm doing. And our company website is infinio.io if people want to check out that stuff.
Thanks again for coming on the show, Bob.
Thanks for having me, Mark. It's a pleasure.